What started as a policy maneuver in Washington has now escalated into a financial standoff that's shaking North America's economic foundation. Markets opened in tension this morning as reports confirmed that Canadian regulators had moved to restrict certain expansion activities of major American banks operating north of the border. Within minutes, financial stocks in New York dipped, analysts scrambled to revise projections, and the ripple effects of tariff-driven tensions became impossible to ignore. This isn't just another trade dispute headline. This is the kind of escalation that forces investors, policymakers, and corporations to confront a bigger question. How far will economic retaliation go in an era where tariffs are used as political leverage? The roots of this moment trace back to the aggressive tariff strategy introduced under the administration of Donald Trump, designed to protect American manufacturing and reduce trade imbalances. The tariffs targeted steel, aluminum, and a wide range of industrial goods. The justification was national security and economic sovereignty. The message was clear: America first. But in global economics, every action creates a reaction. Canada, America's largest trading partner and closest economic ally, initially responded with measured countertariffs. Officials in Ottawa emphasized diplomacy while preparing defensive economic measures. For months, negotiations simmered behind closed doors. Financial institutions hoped the tension would cool. It didn't. Instead, sources within Canadian financial oversight bodies began signaling that regulatory reviews of U.S. bank operations would be reassessed in light of evolving trade realities. That language sounded bureaucratic, but on Wall Street, it translated into risk. Today's move appears to be the culmination of that reassessment. Several major American banks seeking to expand retail and investment services in Canada have reportedly faced delays, additional compliance requirements, and temporary licensing restrictions. While Canada has not announced a blanket ban, the practical effect is significant. Growth pipelines are stalled, and projected revenue streams are now uncertain. Markets don't like uncertainty. Within hours of the announcement, analysts estimated potential exposure in the multi-billion-dollar range over the next fiscal year if restrictions persist. The immediate stock market reaction reflected investor anxiety, not just about Canada, but about what this signals for broader global retaliation patterns. Because this isn't just about two countries. It's about the weaponization of financial systems and trade disputes. For decades, U.S. and Canadian banks operated in a largely integrated North American financial environment. Cross-border lending, infrastructure financing, corporate mergers, and commodity hedging flowed with relative ease. Canada's banking sector, often considered one of the most stable in the world, has historically welcomed American financial institutions under regulated frameworks. Now, that trust appears strained. Canadian officials argue that when tariffs disrupt industries, especially steel, auto manufacturing, and energy, domestic regulators must ensure financial stability. If American policies increase economic volatility, oversight must tighten. It's presented not as retaliation, but as prudence. Yet in Washington and New York, the interpretation is different. Financial commentators are calling it strategic retaliation, a message that tariffs won't go unanswered. The deeper concern on Wall Street isn't just lost expansion opportunities, it's precedent. If Canada, one of America's closest allies, is willing to use financial regulatory pressure as leverage, what stops other nations from following the same playbook? Imagine European regulators tightening oversight on American banks in Frankfurt. Picture Asian markets reassessing licenses in response to future tariff waves. Financial globalization thrives on predictability. When political friction bleeds into regulatory environments, capital retreats. That's the real shock. Investors are recalculating risk premiums for cross-border operations. Bank executives are quietly reviewing contingency plans. Some insiders suggest that American financial institutions may slow investments in Canadian markets until clearer policy signals emerge. Meanwhile, Canadian banks could gain short-term advantage domestically. Reduced American expansion might ease competition in certain sectors. But there's a long-term cost to both sides. Financial fragmentation increases transaction costs, slows trade financing, and dampens investor confidence. The timing couldn't be more delicate. Global markets are already navigating inflation pressures, energy price volatility, and geopolitical instability. Trade tensions layered onto financial restrictions create a compounded effect. It's not just tariffs on steel, it's trust on trial. Supporters of the tariff strategy argue that tough economic tactics are necessary to correct decades of imbalance. They point to reshoring manufacturing investments and renewed industrial policy focus. They claim short-term turbulence is worth long-term sovereignty. Critics counter that modern economies are too interconnected for isolationist maneuvers. Banks, supply chains, and capital markets operate in ecosystems, not silos. Pressure on one node reverberates through the network. And that's precisely what we're witnessing today. Currency markets reacted cautiously. The Canadian dollar fluctuated as traders assessed capital flow implications. Bond yields adjusted slightly as investors sought safer assets. Even commodity markets felt subtle tremors, given Canada's role as a major energy and resource exporter. But the most intense conversations are happening behind boardroom doors. Executives are asking, is this temporary brinkmanship or the start of structural decoupling? If it's temporary, markets may stabilize once diplomatic channels reopen. If structural, we could be looking at a new era of regional financial blocs, where political alignment increasingly dictates capital mobility. History offers cautionary lessons. Trade wars rarely stay contained. They escalate in cycles: tariffs, counter-tariffs, regulatory scrutiny, capital controls. Each move invites a response. And while policymakers may frame decisions as strategic, markets experience them as shocks. Wall Street thrives on growth narratives. When access to a stable neighboring market like Canada becomes uncertain, projections shrink. Yet the situation remains fluid. Neither Washington nor Ottawa has closed the door on negotiation. Officials on both sides emphasize that economic partnership remains vital. Canada exports billions in goods to the U.S. annually. American investors hold significant stakes in Canadian infrastructure, energy, and technology sectors. Decoupling would be costly for both. Political analysts note that economic toughness plays well domestically. Standing firm against perceived unfair trade practices resonates with certain voter bases. But governing requires balancing political optics with economic reality. Right now, markets are voting with caution. Financial institutions are stress-testing cross-border portfolios. Legal teams are analyzing regulatory language for potential appeals or adjustments. Lobbyists are engaging quietly with policymakers to de-escalate tensions before they harden into permanent barriers. The next few weeks will be critical. If Canada's restrictions expand beyond expansion controls into operational constraints, the financial impact could deepen significantly. If the U.S. responds with further economic measures, the spiral intensifies. But there is another possibility. Sometimes, strategic pressure is used precisely to force negotiation momentum. By signaling capacity for retaliation, Canada may be seeking leverage to recalibrate tariff policies. In high-stakes economic diplomacy, visible escalation can precede compromise. Investors are watching every statement, every regulatory filing, every diplomatic meeting. Because beyond the headlines lies a fundamental truth. Modern economies are intertwined at levels deeper than politics often acknowledges. American banks finance Canadian energy projects. Canadian pension funds invest in U.S. real estate and technology firms. Supply chains cross the border multiple times before a product reaches consumers. Tariffs and financial restrictions disrupt not just corporations, but households. Mortgage rates, car prices, investment portfolios all feel the ripple. That's why today's development matters. It signals that economic nationalism carries complex consequences. Protectionism may protect certain sectors, but retaliation reshapes the broader landscape. As trading closed today, volatility remained contained, but tense. No panic yet. Analysts describe the mood as watchful. Markets are absorbing the shock, not collapsing under it. But the real story is unfolding in the shadows of negotiation rooms. Will Washington soften tariff positions? Will Ottawa ease regulatory pressure once concessions appear? Or are we entering a prolonged phase of economic brinkmanship between two historically aligned nations? For now, one thing is clear. The integration that defined North American finance for decades is no longer immune to political friction, and Wall Street is learning, in real time, that trade wars don't just tax goods, they test systems.